Welcome to This Explainer. I am absolutely thrilled to have you here today, because we're jumping right into what is arguably one of the most fascinating and honestly famously misunderstood areas of financial analysis. Today, we're decoding the legal dual reality of corporate tax accounting, focusing in on Learning Module 9, Analysis of Income Taxes. I know, it's income taxes, but trust me on this. Once you see how this actually works behind the scenes, you're going to look at every financial statement in a completely different light. If we want to accurately project a company's future cash flows, mastering this isn't just optional, it's absolutely essential.
Okay, let's dive right into this mystery. If you've ever looked closely at a major corporation's annual report, you might have noticed something, well, kind of strange. Why do companies essentially keep two different sets of books? You see, the income tax expense reported on a company's income statement often differs wildly from the actual check they write and send to the government. So how is that perfectly legal? And more importantly for us, what does that gap actually tell us about the company's true financial health and their future cash obligations? Well, that's exactly what we're going to figure out.
To get us through this famously complex topic, here's our roadmap. We'll cover 1. The dual reality of taxes, 2. Temporary versus permanent differences, 3. Deferred tax assets and liabilities, 4. The 3 corporate tax rates, and finally, using income tax disclosures.
All right, Section 1. The dual reality of taxes. Let's establish the core conflict at the heart of this accounting mystery.
It basically comes down to accounting reality versus taxable reality. On one side, we have pre-tax accounting profit. This is driven by prevailing accounting standards, and it's meant to give investors an accurate picture of the company's performance. This is what drives the reported income tax expense on the income statement. On the flip side, we have taxable income. This is strictly driven by tax laws, and it dictates the actual taxes payable in cash to the government for that exact period. Because these two ledgers have fundamentally different goals, the carrying amount of an asset or liability on the financial statements frequently differs from its tax base. And boom, that right there is where our dual reality is born, creating a ripple effect across the entire balance sheet.
Moving on to Section 2, Temporary versus Permanent Differences. Let's uncover the specific culprits causing this split between the two ledgers.
The crucial point here is that not all differences between accounting profit and taxable income are created equal. Temporary differences are, well, exactly what they sound like, a temporary mismatch in timing. Say tax rules let a company use accelerated depreciation to lower their tax bill today, but accounting standards require straight-line depreciation for their reports to investors. Over the whole life of the equipment, the total depreciation is exactly the same, right? It'll naturally reverse and correct itself in the future. Permanent differences, on the other hand, they literally never reverse. If a company gets hit with a regulatory fine, they expense it on their income statement, but the tax authority is never going to let them deduct that fine to lower their taxes. Or conversely, if the government hands out a green energy tax credit, that reduces the tax bill permanently without affecting pre-tax accounting profit in the same way. For us analysts, permanent differences are vital because they directly and permanently alter a company's effective tax rate.
Section 3. Deferred tax assets and liabilities. So how do accountants balance the scales when these temporary differences happen?
Let's look at the deferred tax asset, or DTA, first. Think of a DTA essentially as a prepaid tax. This happens when your taxable income is higher than your accounting profit today, which means you're paying more cash to the tax authorities right now than your financial statements suggest you owe. But since this is a temporary difference, you've effectively prepaid the government and you fully expect to recover that value through future tax savings. Things like upfront research costs or rent received in advance can trigger this. For an analyst forecasting cash flows, finding a valid deferred tax asset is a beautiful thing. It points to future periods where the cash tax burden is going to be lighter.
Conversely, we have the deferred tax liability, or DTL. This is created when you get a tax break right now, but you will absolutely for sure owe those taxes later. Going back to that depreciation example, if you use accelerated depreciation for tax purposes, your taxable income drops and you pay less cash today, but your financial accounting income tax expense stays higher. You're going to have to pay the piper eventually, so you record a deferred tax liability on your balance sheet to acknowledge that future obligation. Actually, savvy analysts often view these deferred tax liabilities as kind of like an interest-free loan from the government, freeing up cash for the company to reinvest today.
Now, at the end of every reporting period, accountants have to recalculate these items. They do this by comparing the balance sheet carrying amounts to the respective tax bases. It's a neat mathematical relationship. If an asset's carrying amount is greater than its tax base, you get a deferred tax liability. If the asset's carrying amount is less than its tax base, you get a deferred tax asset. And for liabilities, the rule naturally just flips.
By meticulously mapping these carrying amounts against the tax base, analysts can perfectly calculate the deferred tax items and anticipate when those reversals will finally hit the cash flows.
But this raises a really important real-world scenario. A deferred tax asset is only valuable if you actually have future taxable profits to offset against it, right? So what happens if a company is struggling and they simply don't expect to make enough future profit to actually utilize these deferred tax savings?
Well, this brings us to a critical metric, the valuation allowance. Under U.S. GAAP, if there's doubt about a company realizing those future economic benefits, management has to step in and establish a valuation allowance. This directly reduces the amount of the deferred tax asset on the balance sheet to an amount that is more likely than not to be realized. Listen, if you see a company suddenly increasing its valuation allowance, you need to pay close attention. It is a massive red flag. It essentially tells us that management themselves are doubting their own ability to generate sustainable profitability in the future.
Okay, Section 4. 3 corporate tax rates. Let's assemble our toolkit for evaluating a company's true tax burden. When you're analyzing a company, there are 3 distinct tax rates you absolutely need to track. Mixing them up will completely ruin a financial model. First is the statutory tax rate. That's simply the legal corporate income tax rate in the country where the company is domiciled. Second is the effective tax rate. You get this by taking the reported income tax expense on the income statement and dividing it by pre-tax accounting income. And finally, the cash tax rate, which is the actual cash taxes paid that period divided by pre-tax income. While the statutory rate is the legal benchmark, we rely heavily on the effective rate for income statement forecasting and the cash tax rate to accurately project true free cash flows.
Finally, Section 5. Using income tax disclosures. Let's apply everything we've learned to see exactly why this matters in the real world.
Looking directly at Johnson & Johnson's consolidated statement of earnings from their actual disclosures, we can see exactly how this plays out. Financial accounting standards require companies to provide a detailed reconciliation of their statutory tax rate to their effective tax rate right there in the footnotes. By analyzing this table, we can identify precisely how a massive multinational corporation navigates these complex variables to optimize their global tax position.
So, get this. J&J reported a shockingly low 8.3% effective tax rate in 2021. As a U.S. corporation, their statutory tax rate was 21%, so how on earth did they legally drop their income tax burden by more than half? Well, by decoding the footnotes, we can see this massive drop is primarily driven by their international operations, which reduced their rate by a staggering 16.4%. Without understanding the fundamental difference between statutory and effective rates, and without knowing how to read a tax disclosure reconciliation, you'd be completely blind to how a company like J&J actually generates and protects its after-tax cash flows.
Which brings us to the ultimate takeaway. If a company's income statement shows record accounting profits, but you dig into their tax disclosures and find out they're relying heavily on valuation allowances to write down deferred tax assets, what is the true reality of their future cash flow? Are those profits actually real, or is the foundation starting to crack? I'm going to leave you with that provocative thought to ponder because it highlights perfectly why mastering income tax disclosures isn't just some tedious accounting exercise. It is literally the ultimate key to unlocking a company's true financial reality. Thank you so much for joining me for this explainer, and remember, always keep questioning the numbers.